And now it's time to welcome back to the show Rob Lees from Mortgage Choice Blue Mountains and Penrith for our weekly finance segment. And today, Rob, we're going to be answering some questions from our listeners that they've submitted over Facebook.
That's right.
Excellent.
Great to get some audience interaction. So this is a question from Kate. Kate, I hope you're listening. How risky is buying property as a self-managed super fund?
Yeah, this is a good question. Thanks, Kate. And it was good to get some responses from social media, actually, so and to get a little bit of discussion going on there amongst Facebook friends too. So I enjoyed that. I guess in this one, is it more risky? I guess it's not It's not any more risky buying property in super as it is buying property outside of super. However, I guess it's just to be aware that the rules that managed super funds make it something that we've got to just be a little more careful about. So I think the first thing is that you need to make sure if you're buying property in super that particularly if you're borrowing to buy that property, that you've got enough cash going into the fund to service the loan, and particularly to make sure that the contributions that you need to make in terms of concessional contributions into the fund aren't going to exceed any caps, so that you're not paying too much tax. So it's important to get the right advice on that to make sure that that's within those limits. Secondly, you'd need to make sure, as with any superannuation fund, that it's a complying superannuation fund. And one rule in particular that a lot of people overlook when it comes to buying property within a self-managed super fund is that the fund has to be an Australian resident. So if the majority of the assets in the fund are owned, for example, by people who live outside of Australia, it is no longer a complying fund. So if you buy property within super and decide to live overseas for a period of time, you could be in big trouble. And the third thing that you need to be aware of if you're buying property within superannuation is to be aware of the restrictions on the use of that property. So it has to meet the sole purpose test. It has to be for investment purposes. You can't live in it, you can't rent it out to relatives, you can't use it for holidays, you can't renovate it, and so it has to be kept within those rules. So again, I'd always say it's very, very important to get the right advice before jumping into buying property within superannuation. But otherwise, it's a very good investment, and within a superannuation fund, because it's concessionally taxed, there can be all kinds of advantages.
Well, good advice, and sounds like the right advice.
And we can always help with that. I mean, as people look at it, I often meet with people, and we often have joint meetings with our financial planner as well if people are looking at that sort of thing.
Okay. All right. Well, the next one is a question from Ian, and we hope Ian's listening as well. Ian's asking, what's your opinion on the strategy to rent a property to live in and own properties that are rented? So, for example, income producing and tax deductibles. Is that a better strategy for Gen Y?
Could be a better strategy for anyone, really. So do we understand that question there? What Ian's asking then is it better for us to buy property, is it better for us to live in property that we rent, so we don't own it?
Yep.
And we just buy investment properties?
Yeah, and we rent those out.
Yeah, that's right. Well, if we model that, again, generally speaking, it depends on everyone's circumstances, but generally it is more financially advantageous to do it that way. So we actually would make more money if it's just all about the numbers. Again, generally speaking, we would make more money buying only investment properties and living only in rentals. And the reasons for that are that the interest is tax deductible. If it's a newer property, we're claiming depreciation and all that kind of thing. But the thing that would skew the figures, of course, is it depends how much rent you're paying for the property you're living in. It'll depend on the rental return for the property, the investment property that you own, and the amount of depreciation you can claim, the amount of income you earn, and your marginal tax rate, and all those sort of factors.
And would there be a sort of the idea that that negative gearing's part of that sort of whole tax deductibility, and there seems to be some movement at the gate, doesn't there, in regard to sort of pulling back on some of the concessions around negative gearing?
It hasn't happened yet, but it could happen.
On the cards, isn't it?
And some things I was reading during the weekend, it seems that if there are changes, they may not be sweeping changes. I think they may be targeting more people that might own multiple investment properties, but it does mean that if those changes come in, it might mean that those kinds of strategies need to be revisited. But I guess this kind of strategy is something that a lot of people use who are living in the city, and it's Ian, who's asked this question, has asked if this is a good strategy for Gen Y, and I guess what he's got in mind there is that Gen Y perhaps are at a stage of life where they haven't quite settled down yet. They're not really ready to put down their roots. So yes, it could work very well. Rather than getting yourself locked into an owner-occupied property, you can live where you want to live, and a lot of people want to live in the city and are happy to pay rent to live where they want to live. They can't afford to buy in the city, so they'll buy investment properties where they can afford, or investment properties that are more strategic in terms of potential capital gain, and it's quite a good strategy to follow. I had one of my other Facebook friends, Dave, was commenting on this, and he said he came across a strategy where the parents were living in the kids' investment property and the kids were living in the parents' investment property. Now,
okay,
that can work financially.
Yeah.
Financially, it actually isn't a bad way to go. Because both of them then are getting, both families are getting a tax deduction for the loan. I guess if it's held within the family, you've got perhaps a little more freedom, a little more security.
Yes, I mean, you're not going to be sort of sold from underneath you.
That's right. And normally you can't do things to the property, but perhaps by negotiation, you could do it if it's your parents' property or your kids' property.
I mean, hopefully you'd get on well with the landlord, wouldn't you?
I was going to add that. Of course, that assumes that your relationship with your kids and your parents are going to stay okay. So there could be some risks there, but yeah, look, it could be a legitimate strategy.
Great. Okay. Well, let's play a little bit more music before we come back and look at some more questions. Here's Robbie Williams with "Not of This Earth." Robbie Williams, formerly of Take That, with "Not of This Earth." And we're back with Rob Lees. Rob, this is a question from Graham. How do I calculate the approximate capital gains tax on a property that I've had for 15 years and just sold? Well, you'll be up for a fair bit, Graham. I've claimed deductions for interest and other expenses throughout that period. That's 15 years.
Yeah, well, there's actually three methods that you can use in calculating your capital gains tax. The first is the most popular, and it's the capital gains tax discount method, and I'll give you an example of that in a little while. Second one is the indexation method, which would apply in this case. If you've purchased property from before 1999, so 15 years may come into that, you could use this method, but you don't get a discount. So you would get your cost base and apply the indexation from CPI, and I guess you compare both methods and see which is going to be the most favourable. The third method is what the ATO calls the other method, and the other method really is just a normal capital gains tax calculation without any discounting. But let's assume it's the capital gains tax with the discounting method. I'm going to assume, because Graham lives in Epping, suburb I grew up in, or Carlingford I think it is now, I think they moved to Carlingford, and I'm going to assume they sold this property. I don't know where it is, I don't know anything about it, but I'm going to assume they sold it for $800,000, and let's assume they purchased it for $200,000. So that would be a $600,000 profit, which is a nice profit to make, isn't it?
Not
Until
bad.
the taxman gets his hands on it. But what you would do is work out what the cost base is. Let's imagine the cost base was $200,000. So it really is the price that you paid plus the stamp duty plus the legal fees and any other fees that were associated with buying the property. But to make it easy, let's say it was $200,000. And then that needs to be subtracted from the net proceeds of sale. So the sale price less the agent commission and any legal fees. Again, let's assume that's $800,000, and we've got $600,000 there. If you discount that profit by 50%, which you can do if you've held the property for over 12 months, then the amount of capital gains to be assessed is $300,000. And if they both own it together, and I'm not sure if they do, but we're going to assume that both Graham and his wife own the property, it can be split, that $300,000 can be split between the two of them 50-50. So it's $150,000 each that needs to be added on to their income for this financial year. So again, let's assume
that could bring them up into another tax bracket, couldn't it?
Well, that's why it could cost them a lot of money. So let's assume they're on average salary of $80,000 a year each, and we add on $150,000 to that. That's going to give them each a taxable income of $230,000 for this financial year. So it will increase their tax from just short of $20,000 a year up to about $82,000
Rob,
a year.
I mean, because I've been hit with capital gains when I've sold an investment property. You do have a fairly long period of time though to pay the capital gains tax, don't you?
Yeah, well, I think there's things that you could work out and get some advice, of course.
I think it's like,
from your accountant.
I think it's 13, 14, 15, something like that. You're given well over a year before you actually have to pay.
Yeah, and your accountant would advise you on that. This is a fair bit of tax, but remember, they have made a profit in this scenario of $600,000 and paying tax of about $124 on my calculation. So still a fair bit left over. But it does mean that you've got to be careful you don't spend it all at once and think, wow, look at all this money we've got. Make sure that you see your accountant, get some proper calculations done, and put that money aside so it's there when the tax man comes for it.
Good advice indeed, yes. Don't have that philosophy of, I've got this money, I won't waste it, I'll spend it.
That's right,
You're better
yeah,
off,
that's right. Otherwise you could be in trouble.
You could.
Yeah, and again, is it? I mean, there's some talk too, isn't there, about actually looking at the rate of capital gain that is applied.
That's on the table.
Yeah. Is it currently? Look, correct
right.
me if I'm wrong. Is it currently 18%?
Well, no, it's this discounted method where if you've held the property for 12 months, it's discounted by 50%, but it's added on to your other income.
And the other nice thing too, if you've actually made a loss too, you can get a capital gain credit for any other sort of gain
That's
you've
right.
made on another asset as well.
Yes, that's right. If it's other assets, maybe shares or something like that.
All right, that's terrific. Now, it's great to get some questions from our Facebook followers,
Absolutely.
or from your Facebook followers. Now, if people want to find you on Facebook, how do they do that, Rob?
Just look up Mortgage Choice at Blaxland and Penrith.
All right, and are we asking for more questions for next week?
Let's do it again, hey? Let's do it again. I actually gave away this time to try and entice people to ask questions. I've been giving away $30 Coles Myer vouchers. So look, it's just a little thank you, and I'll do it again this week. How about it?
Fantastic.
Another 3 are up for grabs.
And there was a question from Narelle, which we don't have time to ask, but we'll actually look at that next week, okay, Rob?
Yeah.
We'll bring
look at
that question
Fantastic.
across next week. All right, lovely. Thanks again for joining us on the show, Rob.
Pleasure.
And that is, of course, Rob Lees from Mortgage Choice Blue Mountains and Penrith, and you can contact them on 4739 9749 or visit their office at 3/13 Hope Street in Blaxland. And we'll see you again next week, Rob.
See you next week.
Terrific. And that's